Mortgage madness. How do the changes to the interest rates are going to impact you? Hello, everyone, and welcome back to another episode at Novarise, your channel for financial education. So, in today's episode, it's actually a very long due episode because the announcement of the changes to the interest rates happened in late January. But I wanted to wait a couple of days to see if I could collect more information in hopes to see whether more details are going to be shared by the Fed. So, in today's episode, what we're going to do is just to analyze a couple of articles and highlight the key facts that you need to pay attention to and see how those changes will impact you, whether you're looking to invest in real estate, whether you're looking to take out a loan for your business or for any other purpose that you have. This episode it's going to help you understand the changes that are happening and how you can adapt to them. So without further ado, let's just jump straight into the first article. All right, so the very first thing that we have here is that Powell opens door to faster rate hike path to curb inflation, right? So as you move along, you will see here that Jerome Powell made clear the Federal Reserve will act as needed to cool the hottest inflation in almost 40 years, okay? Endorsing interest rate liftoff in March and opening the door to more frequent and potentially larger hikes than anticipated. So for those who are actually wondering inflation, what are you talking about? Like the highest in year? So here's a graph right here that was provided by Bloomberg. And they sourced this from the Bureau of Labor and Statistics, and it actually shows the inflation hikes that have been happening since the 1980s. So as you can see here, you have the peaks here on the 80s, and then if you were to compare the peak that we're getting currently in 2022, or better said 2021 data, you can see that it's the highest it has been since the 80s. So that's what they were referring to in this article. So now you might be wondering, okay, but how much are the rates going to go up by? Like, what's the increase like? Well, there's been various opinions out there. Depending on the expert that you are reading into or the opinion of the expert, you will find out that their opinions are likely to differ. So, for example, we have here Nomura Holdings said that it now expected the Fed to hike by 50 basis point, meaning at 0.5% in March, and then by 25 basis point in May, June, and July, meaning that for the subsequent months, May, June, and July, they're going to hike an additional 0.25. BNP Paribas SA projected quarter point increases over the year, both previously anticipated 4 basis point shifts over 2022. So now I want to highlight this whole talk about basis points and stuff like that because sometimes it can be quite confusing. So what does a basis point mean? So every time you read on the paper that they're talking about a 50 basis point, we're technically talking about a 0.50% rate, right? If you're talking about 25 basis point, then they're referring to 0.25%. So we read recently that the expectation is that the Fed could raise somewhere between 0.25 or 0.50. So what does it look like for you? So let's say, for example, we go by the assumption that the Fed is going to raise the rates 5 times this year. So we're getting 0.25%. And if they're going to raise it 5 times this year, this means that for you, your interest rate this year is going to go up by a total of 1.25. Not all at once, but gradually. So you get 0.25 in March, then what they said somewhere in May, and then they said in June or July, whatever that is, it's going to be a gradual change. So how does it impact you? Well, let's see. Let's say, for example, let's analyze some of the historical rates that we've had according to what we see here and this table provided by Freddie Mac. So currently we are at a rate of 3.45, right? So when you take 3.45 and we come here, so we have 3.45 over here, that's the current rate, and then we add 1.25, we're talking about a rate of 4.7%. So why did they decided to do this in March and not earlier this year, right? So the Fed was looking for more data because they didn't want to react to any weak data proceeding from January and February. They wanted to get their facts right. And hopefully once they get everything in March, they should be able to have enough information to make that determination whether they actually want to take that rate increase and start either increasing it by 25 basis point or by 50 basis point. But at this point, none of us will know. What we can is just to take an educated guess as to what that rate could look like. And based on what we saw here, it could look somewhere between the 4.5% to 5%. Now, is that a bad thing that it's going up? Well, depends on how you want to look at it. So based on this article here provided by Reuters, it mentions that Fed Barkins says rates should move to pre-pandemic levels, then assess next steps. So if we are comparing this rate right here, that is 4.7 to rates that were at a pre-pandemic level, this is what we'll see, okay? So the pandemic started to shed light somewhere in December of 2019. So here's 2019 right here. And then these were, this is kind of like the benchmark where everything starts. So can we say that the increase in rates would put us at pre-pandemic level? Well, if we take a look into the rates that were in effect in 2019, we can see that somewhere between January, February, and May, these were the rates in the market, somewhere around the 4.5%. So if we were to compare this 4.5% to this 4% here, this was literally pre-pandemic level. And you can say that according to the projections, it looks like we're going to be in pre-pandemic levels. So now that you have these facts taken into consideration, you might probably wondering, okay, so how does that really impact me? Well, an increase in rate not only affects your mortgages, okay? It also affects your car loans, any personal loans that you want to take, any business loans that you're looking to take in order to expand your business to the next level. And it can even affect your credit card rates because depending on how inflation is evolving, depending on the rates that the Federal Reserve decides to implement, that could also be reflected in any of these scenarios that you see right here, aside from your mortgage. So what do you have left to do? Well, as we said it many times in this channel, all you have to do is just to keep monitoring and monitoring the market, paying attention to articles like these or the ones that are released by the Associated Press to keep you informed as to what can happen and how you can adjust to those changes in the market and determine your next move. So let's say, for example, if you're looking to invest in real estate and you have a house in place and you're ready to make an offer on it, you should move towards it right now and not wait until the future because a difference in those rates can impact your mortgage payment and your cash flow. So let's say, for example, under current rates, I believe that what we saw here was what, 3.45. So if your current rate for a mortgage is at 3.45, and your mortgage payment came out to be $2,300, right? That's the price that you're going to be set for under this rate for the next 30 years or so, right? But if you don't move quickly or if you wait until what the Fed announces or something like that, it could be that your next rate could be an increase of 25 basis points that we talked about. So your new rate will now be at 3.70. And this rate could make your mortgage payment go up. And you could be dealing, and I'm just throwing an arbitrary number here, and your new mortgage payment could be $2,500 a month. Now, if you're paying out of pocket because you're looking to buy a home for yourself, that's an extra $200 that you're going to have to come up from your pocket. And if you're buying a property to invest in real estate, that's a $200 cash flow amount that you're going to have to let go and invest that towards the interest rate because of this rate increase that happened right here. Now, just to reiterate, I want you to understand that because of this, you shouldn't jump into any property that crosses your path just so you can lock in the rate and not deal with the future. Of course, it has to make sense for you, okay? So make sure you do your due diligence, you analyze the pros and cons, and whether it's worth it for you to pay that extra $200 out of pocket because maybe you're not finding out the right property. And if the answer is yes, please proceed, go ahead and do that investment as long as it makes sense for you. Okay. Now, speaking of the Federal Reserve, if you're looking to learn more about that institution and how the decisions that the Fed makes impacts your daily life, here's an episode on the site here that you should definitely check out that's going to help you complement everything you just learned today. So, see you at the next episode. Take care. Bye bye.